Hello, everyone. Welcome to Demand Supply Trading Practical Session number 8 for the year 2025. Myself, Srijit Kakkar, and today is Sunday, 23rd of Feb 2025. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So we do have a Telegram channel where we keep updating you stuff related to demand supply, be that the schedule of these live sessions, be that some upcoming promotions, be that some videos. So in case you have still not joined this channel and you wish to join it, you can do that by scanning the QR code which is available on your screen. Otherwise, you can also find the direct link in the description. And what you can also do is once you come to our website, which is srijitkakkar.com. Otherwise, you can use the short URL, that is sk.coach. So once you are on our website, just give me a second. You can scroll down to any of the pages, and here also you'll have the option to join the Telegram channel. You can click on this button, join now, and you can join the Telegram channel. All right, so those are a few different ways of being in touch and being connected. So that takes care of how to be part of that Telegram channel. Now, today's session is a practical application of demand supply and methodology. So what we do in these sessions is that whatever you have learned in demand supply, now the fact is if you don't even know demand supply, you can learn it for absolutely free. So how you can learn the methodology, I'll also talk about it as we move forward. But yes, once you have learned the methodology, which will cover the theory part, unless and until we see some practical examples, at times it doesn't becomes very easy for us to understand how to implement the methodology. And that is what we do in these sessions. So every weekend, I do a practical session where we take an example, and to that example, we apply the complete demand supply methodology. And that helps us understand how to plan trades in a very mechanical and rule-based way. Now, the best part about these sessions is that we are not reviewing something which has already happened and, giving reasons, okay, this is why we would have bought or this is why we would have sold. That's a piece of cake, because something which has already happened, you can pick any indicator, any oscillator, you can apply to your charts, and you can come with a number of reasons why you would have participated or you would have not participated. The real fun is when you are doing the analysis in advance, you're planning in advance the areas where you would like to be buyers and sellers, and eventually seeing how the prices, they reacted to those areas of demand and supply. So that is what we do in these sessions, and that is what demand supply is all about, that you can pre-plan your trades, you can pre-plan the areas where you would like to be buyers and sellers, and eventually when the prices, they revisit those areas of demand and supply sometime in the future, that is the time those trades, they get triggered. And because I'm sharing these examples in advance, that does not mean that I share these examples with you and then we forget about it. Whatever examples, they get triggered eventually, we also review them so that it gives you more confidence in the methodology, because you are able to see the before as well as the after. And that is what we do in these sessions. We are not looking into things which have already happened. We are trying to plan what might happen in the future. And that's, like I already said, is the beauty of demand supply methodology. All right, now to be a part of this, these sessions actively, right, there are some prerequisites. And if you would have completed those prerequisites, these sessions will be much easier on you. So let's talk about what those prerequisites are. The very first one is the Trading Essentials course. Now, this is optional for someone who already has a very good trading experience or trading background. But for someone who's starting as a fresher, I'll say it is very, very important to go through the Trading Essentials course as well. This is also a 100% free course. And what I'll also suggest is that even if you have been trading for a number of years, you have very good trading background, still go through the Trading Essentials course, because there might be a few nuances which you might not know and you might get to know from these sessions. So I'll highly recommend, irrespective whether you're a fresher or you have a lot of experience, do go through the Trading Essentials course. Now, how can you access the course? Very easy. Once you're on our website, you will see that under services, we have the option for courses. Click on courses. And this is where you'll be able to find all our courses listed. So the very first one is Trading Essentials. Click on it. And once you click on it, it will take you to the course page where you have the English lesson options and the Hindi lesson options. The course is available in these two languages. And once you click on whatever language you're comfortable with, it will take you to our playlist. And that playlist contains all the lessons in a very systematic way. You have lesson 1, lesson 2, lesson 3. Go through all these lessons, and that will basically cover your Trading Essentials course. Now, once you are done with Trading Essentials course, the next prerequisite is your demand supply trading course. So like I was just talking about few minutes ago, that our demand supply course is now available as a 100% free course. Now, how can you take this course? Again, on this page, you can see you have demand supply trading course, and you just click on get started. And here also you'll be able to find the course in both the languages, English as well as in Hindi. So whatever language you're comfortable with, in that language, you can take the complete course. It will again take you to our playlist, and all the lessons are right there for you systematically, lesson 1, lesson 2, lesson 3. So go through all the lessons, and that will cover the demand and supply methodology in a theoretical way. Now, once you are done with the methodology and learned it theoretically, like I said, unless and until you see some practical examples, it's not very easy to understand how to implement it. And that is what we do in these practical sessions. Plus, we also have an archive of over 1 year of recordings available to you. So if you want to watch the recordings of the previous practical sessions, you can click on YouTube live sessions. And again, these are available in both the languages, English as well as in Hindi. So you can watch the previous sessions as well. So you have an archive, like I already said, which is over 1 year of recordings. So a lot of content is available to you. The more number of examples you'll see, the better you'll start having the understanding of the methodology. So that basically covers your Trading Essentials course. Now, once you are done with the Trading Essentials and the Demand and Supply methodology course, so I should have said that basically covers both our courses, the Trading Essentials as well as Demand and Supply. Now, the next thing is we now need to apply this methodology, and that is what we are doing in these practical sessions. And to apply this methodology, I have also created 2 documents for you. One is the rule book, the other one is the flow chart. And we use both these documents during these sessions so that you can understand how to plan trades very mechanically and rule-based. So how can you access these 2 documents, which is the rule book and the flow chart? Again, very simple. Once you're on our website, under services, you have the option for downloads. Click on it. And this is where you'll be able to find the rule book and the flow chart. So just click on download and download. And you'll be having these 2 documents. So this is the rule book, and that's your flow chart. So during the session, you will see how we use these 2 documents to plan trades very mechanically and rule-based. So before we start with today's example, we do have 2 trades which got triggered. So we'll start with the review of those trades, because like I already said, just because I'm sharing some examples with you does not mean I share them and then we forget about it. Whatever gets triggered, eventually we start with the review of it. So we'll start with the review of 2 examples. And once we are done with the review of those 2 examples, then we'll continue with our analysis for today's session. So just give me a second. Let me bring the examples for you. All right. So the first one is... All right, so the first one is from session number 7. So session number 7 was on the 16th of Feb. So I did the analysis on the 16th of Feb, and the prices you can see came into the zone on the 17th of Feb. So you can see this is where we entered the zone, which is on the 17th. Now, if I just go to a smaller time frame, what I'll do is I'll take a vertical line here so that we know this is 17th. So if I just go to a smaller time frame, you can see this is what happened. Prices, they came into our zone. Can you see that is where you would have got your opportunity for the fill? And eventually it moved to 1:1. So what do we do at 1:1? At 1:1, we make the trade as a break-even trade. So we would have made it as a break-even trade. Until here, we would still be in the trade, which is your 18th. And then you can see on the 19th, prices again, revisited our area. And that is where you would have been out of the trade. So technically, it will be a break-even trade for us. Now, depending upon whether you had your break-even exactly at the entry price or a little bit above, it could be small little loss or maybe no profit, no loss. But generally, we talk about break-even as no profit, no loss. So we'll close this one as a break-even trade. Though the zone has not yet been violated, but it has only given us an opportunity to make it as a break-even trade, and we are done with this one. So that takes care of your example from session number 7. Now we have another example. Let's also look into that. So this is from session number 3. All right. So this one is from... session number 3, we did the analysis on the 19th of Jan. So your 19th of Jan would be somewhere around here, right? So when we did the analysis, the charts would be something like this. So this is 16, 17, somewhere around here, right? So that is how the chart would be when we did our analysis on the 16th. And the prices, they came into the zone on the we did the analysis on the 19th of Jan and the prices came into the zone on the 18th of Feb. So you can see eventually prices, they started moving down, and this is where you have your 18th of Feb. So 18th of Feb, we came into the zone. We got a move which is about 2:1. So you can see that's your 1:1, 2:1, 1:1. We would have made it as a break-even trade. But let's see what was the reward to risk ratio when the prices they started coming back to our zone. So when the prices, they started coming back to our zone, you can see our nearest opposing zone is this, but this is already a tested zone. We don't take tested zones as our target. Our fresh zone is this. So we have approximately 4:1 reward to risk ratio on this one. So it was definitely a valid trade with a 4:1 reward to risk ratio. And you can see that after getting the opportunity to enter the trade, we have already moved about 2:1. So that's your 1:1, that's your 2:1. We are still hanging around at about 1.5. But yes, now we already have the opportunity to make it as a break-even trade. So this will remain as an open trade for us with our stop loss at break-even, and we'll keep trailing onto it unless and until we get our exit, which the chart is showing us is at about 4:1, right? So for a 4:1, we will be trailing onto it as of now. Trailing as a break-even trade. Yes, we definitely hit a 2:1. Now, somebody who is always happy with exiting at a 2:1, yes, you could have got your exit at 2:1. Maybe if you wanted to book some partial profits, you also have that opportunity. But I'll go with the way I have explained this to you in the rule book, where we will be trailing it for our target, which in this case, as of now, is a 4:1, and we'll see how this one progresses. So you can see that's the beauty of demand and supply. And again, coming back to, you can see, all these examples that we reviewed in today's session, the session before. Even though the markets have been really, really bearish, right? They have been crashing like anything. How beautifully these zones have been holding. Yes, some of them only gave us opportunities to make them as break-even trades, but some of them will also go in our favor. And that's the beauty of demand and supply. Again, we will also be having stopped out trades, right? It's just that just because we didn't have any stopped out trades doesn't mean that we'll not be having them eventually. We will have examples of stopped out trades as well. But you can see how beautifully things they can work. And generally people say you can't catch the falling knife, but yes, if you know how to do that, can you see we probably bought the low of this particular symbol, and since then it has been moving up. In fact, the very next day we had an opportunity to exit at a 2:1 as well. All right, so that's your two examples from session number 3 and session number 7. Session number 7, an exit at break even, though the zone has not yet been violated. Session number 3, trailing it at break even with a target of about 4:1. So we'll see how this one progresses during the next few weeks. All right, so now that we are done with the review of two of these examples which got triggered for us, let's start with our example for today's session. All right, so let's get started. Perfect. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have not yet watched that video, the link is available in the description. Make sure you do watch that video. Very, very important. And follow the process that I've explained in that video, because there is no bypassing it. Eventually, you will have to go through that process. So the sooner you start, the better it is going to be for you. And like I always say, it is easier to say you need to have a trade plan. When you're learning a new methodology, it's not very easy to create a trade plan for yourself from day one. And that is where these documents, they help us to start planning trades very mechanically and rule-based. So what is our step number 1 whenever we start planning our trade? Step 1 is we need to define our trade purpose. And what do we mean by trade purpose? Trade purpose implies the expected duration of the trade, and duration is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, exit can be break-even, exit can be the trailing stop loss, it can also be the stop loss, any kind of exit. So the question is, why am I starting with the trade purpose as our step number 1? And the reason for that is that when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that out of these n number of time frames that are available to me, which time frame should I be using for my analysis? And again, to answer this question, we do not randomly select any time frame. We again go with a very logical approach. And that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes. We call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks, and monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days, but my recommendation to all of you is that if you're trading markets which are not 24-hour markets, then your hourly dailies should be done as strictly intraday trades. Don't keep them as overnight trades. And the reason for that is if you are trading markets which are not 24 hours, I'm pretty sure you would have experienced whenever the market opens the next day, some symbols they gap up, some symbols they gap down. And because of this gap up, gap down, what can happen is if you have a gap in your favor, you might get profit which is bigger than what you were expecting. But if you have a gap against you, you can also lose more than what you were willing to lose on that trade. And that is why my recommendation is to practice risk management by not keeping these positions as overnight positions and take that unnecessary overnight gap risk. Now for weekly, monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that we cannot have a gap against us for weekly, monthlies. It can still happen, but the probability definitely reduces. Plus, like I said, we don't have any choice. We'll have to keep these positions as overnight positions. But with time, with experience, if once you start building up confidence in your analysis, if you want to keep daily incomes as overnight trades, it can be done. But initially, I would advise you to avoid that. So let's assume that my step number 1, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what will happen? From my rulebook, I'll get to know what time frames I should be using for my analysis. Now, demand supply methodology is based on multiple time frame analysis, and we use a minimum of 4 different time frames for our analysis. And those 4 different time frames are higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. And every time frame has its designated purpose. Like higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, that is going to be my 60 minutes chart. And it can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries. Or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now, the next challenge is, yes, I do know my time frames, but if I take the example of NSE, we have over 2,000 symbols listed on NSE. So it's not humanly possible that every day I sit and analyze 2,000 companies. So what do I need to do next? I need to have a process in place for selecting a smaller list of symbols. And the way we do that is by using certain computer programs, which are called as scanners or screeners. Now, we do have some scanner screeners, which are purely built on demand supply methodology. We call it as the demand supply zone alerts and demand supply zone screener. If you want to understand them better, you can click on these links and you can visit the pages, and the walkthrough videos are available, and you can go through those walkthrough videos to understand how they work. I'll also quickly show you how you can do it on our website. So once you're on our website, go to services, and under services, you have trading view indicators. Here also, you'll be able to find the alerts and the screeners. You can click on them. The walkthrough videos are available. You can watch those walkthrough videos to understand how these tools they work. But remember, irrespective what scanner or screener you're using, they are not call giving or tip giving services. They are tools which are helping you get a smaller list based on different logics, and these two are purely based on logics based on demand supply methodology. The process can be as simplified as, okay, I want a smaller list. I will only be analyzing my Nifty 50 stocks. or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that smaller list. But yes, there are a number of options available. These two are purely based on, like I said, demand supply. Then you'll also be able to find a number of scanner screeners which are based on either conventional technical analysis or fundamental analysis. You can even use them if you wish to. So at the end of the day, it's your call how you want to get that small list. Now, once you have that small list, now we are ready to move ahead, because what we need to do next is we need to analyze these symbols one by one. Out of this list, whatever matches with your trade plan might be an opportunity for you. Whatever doesn't match with your trade plan will simply be skipping it. Now, all these examples that I share with you, all these examples I shortlist using the demand supply screener. That is what I do. So just in case at times, I get this question that how do you shortlist your symbols? So I use the demand supply zone screener for shortlisting these symbols. So let's assume that we got a list, and in that list, the very first one was ABC. So what we need to do now is we need to go to the lower time frame on ABC and identify zone. Now, what do we mean by zone? By zone, we mean any of these four structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. And in this case, my lower time frame, we already got to know that as a monthly income trader, my lower time frame is the daily chart. So let's assume this was the symbol. And now we are on the daily chart, and you can see on this chart, I have already applied the demand supply zone indicator. And the best part is that now we are offering a one-time 7 days free trial of our demand supply zone indicator. So in case you have not yet taken the trial, how can you also do that? Let me also quickly explain you. So once you're on this page, again, under services, go to trading view indicators. And on this page, you can see you have your demand supply zone indicator. Click on it. And then on the left, you will see 7-day free trial. Click on it. And this is where you have to provide us with three things. That is your email address, your TradingView username, and your full name. Now, in case you don't know your TradingView username or you don't have a TradingView account, then you can click here to sign up for a free TradingView account. Once you have created your TradingView account, then you can input your username here. If you already have a TradingView account, you can click here to view your profile on TradingView and identify what is your correct TradingView username, because if you provide an incorrect TradingView username, it will not get activated for you. So do ensure when you're filling this form, you're providing the correct information, which is your email address, your TradingView username, and your full name. And once we get that information from you, within 24 hours, it will get activated. And once it gets activated, you'll get a notification on TradingView that it has been activated for you. And then you can try it absolutely for free for 7 days. All right, so now because everyone has that opportunity that you can try the indicator for free for at least 7 days, we will be doing our analysis based on the indicator because it makes the process faster, easier, mechanical, and that also helps you understand the magic of the indicator as well, because all these examples that I've been sharing with you, they're always based on what the indicator is identifying for us. So you can see below the current market price, the indicator is telling us that we do have this drop-based rally structure. So let's mark this drop-based rally. So my step number 3, which was to identify the zone, I've already identified this. The fact is it was already on my list, but unfortunately prices did not touch the zone. Otherwise, you could have already got the fill on this. But since it is still fresh, we'll track it. So we do have a zone available, and that is what we did from our step number 3. Is the zone available? The answer is yes. Now, once you have identified the zone, does not mean that you blindly trade it. The next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. So let's start with our step number 1. So what is the very first condition we look into? The very first condition we check is that can this zone be a case of level on top of level? Why? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone gets divided into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here, that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame zone, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level. But if you don't have a coinciding level, then it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? Now, the beauty of this indicator is that here you can define what is your higher time frame, what is your intermediate, what is your refining. and then you can click on automatic settings so that whenever you are shifting to these time frames, the applicable settings, they get applied automatically. So if I go to my intermediate time frame, which is weekly, you can see wherever my lower time frame zone is, I don't have any intermediate time frame zone. So this is not a coinciding level, and if it is not a coinciding level, it cannot be a case of level on top of level. So going back, level on top of level not applicable. Is the zone because of a gap? The answer is no. Therefore, we will not be applying the gap rules as well. Next, is it a structure of a pivot or a non-authentic zone? The answer is yes, because it was a drop-based rally structure. And to drop-based rally, we always apply pivot and non-authentic rules. So what are the pivot and non-authentic rules? Now, there are two different approaches I've given you. If I go to the rule book, the first one is the aggressive rule. The aggressive rule says that before applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So what we want to see here is that the move which started from here, it should have violated a supply area and not of the same time frame of the intermediate time frame. I'm pretty sure we will be able to see it. So if I just go back to my weekly time frame and I do a replay, because this is where the zone was formed on this particular candle. And now I'm pretty sure you'll be having some opposing supply areas. Can you see we have this supply area, and eventually when the prices, they started moving up, you will see that this definitely violated this area of supply. So let's give it a few seconds just to show you. And you can see the supply was violated. So the condition I wanted, that the move from this area should have violated an opposing zone on the intermediate time frame, is definitely applicable. So going with the aggressive rule, this is definitely qualified for me. Now we have another approach which is called as the conservative rule. The conservative rule, why? Because now we are looking at two factors instead of looking at one factor. And it says before applying the boosters, make sure you have an impulsive move on the intermediate time frame. And we can see we already have that. So when the zone was formed, this was my most recent pivot high. And then you can see prices were able to breach that and create a new high. So we do have an impulsive move. So the very first condition of the conservative rule is definitely applicable. And the second condition is that on the refining time frame, I need an authentic zone. So let's verify that as well. So in this case, my refining time frame will be the hourly chart. And if I go to the hourly, let's give it a few seconds. In fact, what I'll do is I'll just change the settings to only identify on the visible chart so that the indicator loads faster. So you can see on the intermediate time frame, on the refining time frame, we do have a rally-based rally structure on the refining time frame. So in this case, irrespective whether you were applying the conservative approach or the aggressive approach, in both the cases, the zone is qualified for us because we have what we wanted to look for in both the cases. So yes, irrespective whether you apply the conservative approach or the aggressive approach, this is a qualified zone for us. So pivot non-authentic zone, the zone was qualified, it did not get disqualified, and unstable equilibrium is not applicable. So the only condition applicable was pivot and non-authentic, and based on the applicable rules, did it get qualified? The answer is yes. So now that we know we have a qualified zone, we can move on to the next step, that is the booster scoring. So let's start applying the boosters. So the very first one is freshness, which we can already see the zone is fresh. In fact, let me also draw the entry stop loss. Just a second. All right. So the zone is definitely fresh, gets a score of 3. The next one is strength, and you can see the indicator is marking the zone because this is an explosive move. So we already have an explosive move, gets a score of 2. Time at the zone, we only have one candle, which is again a score of 2. Reward to risk ratio, will take it as an assumption because nobody knows how the arrival would be. And we can only get to know the reward to risk ratio based on the arrival. So currently we are taking it as a assumption, but when we are about to enter the trade, we'll definitely re-verify it. Next, what is the location? Now, if I go to the monthly chart, which is my higher time frame, you can see I'm planning my zone inside of the monthly zone. This is a monthly drop-based rally. So we are very low on the curve, which is basically the best location to plan a long trade. gets a score of 2. At best location, trend becomes irrelevant. It doesn't matter whether we are in an uptrend, downtrend, or sideways. It will be a score of 1. Move from the zone, we need at least 4:1. And here you can see we probably have a 20:1 move before the prices just started coming back, which is again a score of 2. It is not a case of level on top of level, not even coinciding. We have already verified that. And for trap, I think we can give it a score of 1, because if I take a horizontal line here and start pushing it up, you can see this particular area has beautifully worked like support. Here also worked like support. And in the past, you can see it has also been acting like somewhat resistance. Can you see here it worked like resistance, acting like support, here working like resistance. So we did have a beautiful area, and you can see here we also got a really nice breakout. It's just unfortunate that we didn't have the fill as of now. If the prices would have gone a little deeper, maybe the last week itself, we could have got the fill on this. But since the zone is still fresh, we can look at it as an opportunity for us. So yes, this is a really nice area of support and resistance. So people who believe in support, they would be buying, and their stop losses will be below, which will be sell orders. And in case we get a breakout, then people who believe in breakout will also start selling by the time we are getting into this area of demand. So we know by the time we are in this demand, a lot of selling can be coming into the market because of the stop losses or because of those breakout traders. And these people are making two novice mistakes. Mistake number 1, they're selling after a decline in price, which means they are now selling at a cheaper price. And mistake number 2, they are selling in an area where the chart has proven to us that back in history, demand exceeded supply, which is the only logical reason for the prices to move up. So yes, that possibility is there that this might work like an area of trap. For which I've already given it a score of 1. So if you look at the overall scoring, with the assumption of reward to risk ratio, we have a score of 10 out of 10, which makes it as a high quality zone. And the score for the probability is also 6, right, which makes it as a high probability zone. So high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know this is going to be a type 1 trade for us. Next, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation, so that in case the trade does not go in our favor, it goes against us, we do not lose more than what our risk management rule allows us to lose. Next, whenever the prices are back, we'll have to re-verify, because markets are not static, they're dynamic. Conditions are changing almost every other second. So before entering the trade, whatever we did right now to verify the trade with our trade plan, we have to do exactly the same thing to check, does it qualify based on our trade plan? If the answer is yes, we place our order based on the entry type, in this case, a type 1 trade. And once your trade has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trade, very mechanically, very rule-based. And before we move into the Q&As, I would like to add that if these sessions are helping you, do like the video, share it with your friends who are into trading, your family members who are into trading. If you're also part of some trading groups, you can also share my link to my course content, to these live sessions, even to the free trial of demand and supply zone indicator. So share it as much as you can, so that more and more people can take advantage of it. And another thing which I would also like to add is that, yes, during these live sessions, I do take care of whatever your questions, queries are, which you can put in the chat box. But I have been getting this feedback that in the chat box, we can't share our analysis, or maybe at times we don't want to ask a question publicly, right? We want to have a one-on-one session. So we do have an option for it now. So once you come to our website, you can see on the top, we have one-to-one session options. So now you can schedule a one-to-one session with me, where you can take an appointment. If you feel that you can ask your questions as a telephonic conversation, it's not required for you to share your screen. So you can go for a voice call. And if you feel that you also want to share your screen, you want to share your analysis, then you can book an online meeting. So those two options are available. But yes, otherwise, if you are okay with asking your questions during the live session, which is this YouTube live session, you can also put your questions in the chat box, and I do try to answer as many questions as possible at the end of the session. So let's see, what do we have today before we end the session? When adjusting your stop loss to break even or above, do you prefer to adjust it immediately, or do you allow the price to move slightly above each reward level. See, as soon as it reaches the reward level, right? Because if you think about it, we are already 1:1 away, right? So that is why you don't have to wait that let it go, let's say X% or X amount above my 1:1, or let it close above. So all those things are irrelevant. Again, if you want to be, let's say, extra aggressive, yes, you can follow those rules that, maybe the closing has to be above, right? But ideally, if I have decided my level, if you take the same example, can you see this is my risk and this is my 1:1? So after the entry, as soon as it touches this area, you can revise your trailing stop loss, right? So that is something which can be done. But again, like I always say, different traders, different personality styles. Some people might want, okay, let the price close above this, only then I'll make it as a break-even trade, or maybe let it go 0.5% above this. So all those things would depend upon how aggressively or conservatively you want to approach. Otherwise, 1:1 is good enough if you want to make it as a break-even trade. Perfect. So that answers your query. And that also brings us to the end of today's session. Thank you everyone for joining in. I'll be seeing you now next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye-bye.